Okay, the session is being recorded, and so while we wait another couple of minutes to allow everybody to gather for the last session, which is dedicated to contingent capital and convertibles, I would like to, to give you an opportunity to, to check whether there are any open points in all the lessons that we had together in the previous days. So do you have any issues, specific issues that is not clear you want me to address, and so on and so forth? Otherwise, we started with the last session on contingent capital and convertible. And again, if you feel comfortable, I wouldn't mind you to raise hands and speak rather than writing, because it is a good proxy of a real interactive session physically delivered in the class, rather than a remote session as we are doing at the moment. So don't be shy. If you want to speak, I'm happy to to have the interaction that way. Otherwise, we go as usual in writing. So it looks to me that everything is clear, and we can start. Contingent capital and convertible. In session with other professors, you have been talking about how to raise capital as debt. So you position yourself on the top end of the liability side, and with me so far, we have analyzed ways to raise capital as a straight equity. Whether you do a primary as an IPO, whether you do an accelerated book building in offering as a primary, or if you do a right issue, or if you do a private placement, you raise equity. But there are hybrid form, convertible and contingent capital, that sits in the middle of the two liability class that we just have been talking about. I mean, senior debt and equity. And these hybrid de facto are very important in capital market. Number one, because globally represent almost, approximately 10% of the total issuances every year. And, 10% is like 200 billion, 150 billion euro per year, okay? So it's very, very important. And we will see in a second why not only is important in size, but also why it's important in terms of, advantages that provide the hybrid capital for issuer. And the structure of those hybrid are de facto divided in three categories. You can have the normal senior convertible or exchangeable, and we see the difference, when the performance and the structure of these instruments is related to the behavior of the market. So de facto, the hybrid nature materializes when the market performs. So you issue a bond, but the bond butterflies up into equity given the performance of the market. On the contrary, you have the second category of convertible that are called mandatory, when you have a forward sale of these shares, and the structure is such that you shape a collar with some floor and some cap in the upside for the investors, while in the first instrument, the upside of the market above a trigger is totally dedicated to the investors. And then you have the third category, the contingent capital, that are very much related in nature, related to the quality of buffer of capital for regulatory purpose, where the regulator, and for regulatory reasons, especially financial institutions, have these instruments that are forced or requested to issue this contingent capital to provide a buffer for future crises, in order to provide additional equity in case of crisis, and as a result, you buy in this instrument to provide equity in the capital structure. Why you issue convertible bonds? Number one is accessibility. De facto, a convertible bond had substantial capacity for acquisition financing and refinancing. Yesterday in the class 16, I made this example. You know, when you think about a company like Nexi is the result now of three big companies. Nexi, who acquired Nets, who acquired also SIA. As a result of the combination of those three big assets, you have debt that has been put together from the Nexi standalone, Nets, and SIA. And immediately, once the company has been created as a result of the combination of those three assets, the CFO needs to refinance debt, because in each of the situations, there was a change of control clause. And basically, you need to refinance debt in the marketplace. And guess what? Given the market condition now, you know, one of the normal refinancing, option is a convertible. And indeed, Nexi issued a couple of weeks ago €1 billion convertible in order to finance existing debt in the marketplace. It is an efficient debt instrument and substitute, because if you have a normal senior, which is either a bond or a loan, you issue those instruments and you finance yourself based on your credit strengths and based on the level of interest rate. With a convertible, you have an additional feature that we see in a second, which is the optionality embedded in the instrument that allows you to reduce the coupon. So it's a very efficient instrument. You have no covenants, because, for example, a very important feature of this instrument is the lack of clauses like you cannot go over this debt to equity ratio. You cannot go over this level of debt to EBITDA. You cannot go over to any other key performance indicator or ratio, which would trigger a renegotiation or reassessment of your credit status with lenders and bondholders. In this case, with a convertible, you don't have this discussion. You expand the investor base, because when you issue these instruments, you tap class of investors that are untapped before, untouched. And the investors for convertible are investors that are neither in the liability, in the debt, nor in equity, are specifically dedicated. Sometimes are desks within big class of investors, could be Fidelity, could be Blackstone, and so on and so forth. But as a matter of fact, are desks, team, or unit totally specialized in convertible only. So when you issue convertible, you tap, pocket of liquidity and capital that are untouched before. It is an instrument that is flexible as well. because what we'll see in a second is that you need to think about a convertible like a combination of factors that are, pulling, the economics in different direction. So you can have an higher coupon and you can have an higher premium, or if you want to have a lower premium, you can lower the coupon. If you have a longer maturity, you can have a bigger coupon. So in other words, you play with all this variable in order to shape, the dress that you want. You shape the clothes that you want. Rapid execution, very important. A convertible could be placed in the marketplace in a couple of days. After the negotiation of all the terms and conditions with the key investors, you launch it, and as a result, is a very quick and dirty way to raise capital in the market. You got light documentation, and you don't need rating. So let's start to discuss about, the convertible, the normal convertible. What I want you to basically learn is those definitions, fundamentals, and the structuring, because those are the key elements. We're not going to go through details because are very straightforward, but I want you to know, because it could happen that, especially in this format of a exam where we have multiple answers to a question, those are the things that I could ask, because they're the typical things to be asked for a convertible. So you will be reading in the pages that we're going to flip through quickly afterwards, all these characteristics of the convertible. So the convertible is de facto, debt security is a bond that butterfly up into equity by issuing a number of shares at premium to the initial share price. While the mandatory is de facto forward sale of those shares, and you can structure all the redemption, the issue call, the settlement, and dividend protection the way you want, based on discussion with investors. Let's see the first instrument. So we are talking about here the normal convertible, okay? Basically, you pay a fixed coupon. It could be 1%, 1.75, 2%, you name it. You can have a cash redemption like a normal bond, but we have option to do also portion in cash, portion in shares, or all in shares, as we can see later. And basically, the investors have the right to do two things: either to convert, if it's convertible, into the shares of the issuer, or to convert into third-party shares if the issuer has a stake and you issue the bond into those shares, and it's called exchangeable. So in the case of Nexi, you have a bond convertible into Nexi shares, but you could have, for example, a bond of Armani convertible into Luxottica shares. In that case, you have a bond exchangeable into Luxottica, so not in the shares issued by the issuer itself. And let's see the way it works. The bond has a nominal value. He has a conversion right that anytime you could potentially convert into one shares. When you issue the shares, actually, when you issue the convertible, the share price is 80, and the strike price, or otherwise called the redemption price, is 100. And you have, de facto here, a premium, because you issue the shares at premium and maturity at 100, but when the bond is issued in the first place at inception, the price is 80. Okay? Let's see the first scenario. Here is the share price when you issue the convertible. The share price during the life of the bond goes up, down, up, then down, up, like any normal share. And M maturity, if is above 100, if is above a 100, the bondholder as the incentive is rational to be inclined to convert the convertible bond. And basically because the has the possibility to convert the shares at 100, which is the price where you issue the shares, knowing that those shares are trading in the marketplace north of the strike price. Totally opposite is the behavior in case of out of the money. So if at maturity you don't have the same condition, in other words, the share price where the level of price where the shares are issued is 100, but the price is I don't know, 80, there is no point that the bondholder will convert this share. And here you can have de facto, as I write here, at any time, but what is the option embedded in a convertible? So here the bondholder has the possibility, so de facto has a call to convert the shares. And as we know, even though you have the possibility to convert at any time, what is the behavior of the owner of a call? Usually when he converts, when he usually decided to take the decision to convert, and why? Any view? Well done, Daniele. At maturity, because there is no point to convert the shares here, because at the end of the day, you get long of shares immediately, and if the price then goes down, you materialize a loss. You better off, as we have seen in the right issue, you retain the option until maturity, because you retain all the optionality embedded in the instrument. So M maturity, but it's no force, it's an option that you have. And maturity, basically the investors has the possibility, if he's in the money, to convert, or if he's out the money, to not convert and get the money back as a bondholder. And as I said, the redemption at the end, it could be in cash, you get the 100 in cash, or you can have the redemption in case of conversion, either in cash 100, you have shares for the difference. Let's call it the market value of the convertible is 100, okay? So you can have either 100 in cash and 30 with the shares, or 130 all shares, or 130 in all cash. Those are the options for the cash redemption. And here I wanted to spend a bit of time that allows you to really understand the behavior of these instruments. On one side, as with the perspective of the issuer, and on the other side, the perspective of the investors. For the issuer, you de facto you have the exposure to the equity, which is the yellow, actually orange line. And basically, if the share price does not perform, you get all the downside, because at the end of the day, you need to repay 100. So equity doesn't provide you any benefit because you issue at 100, you raise 100, and you de facto you don't participate to any benefit. So you take, if the shares are performing less and less and less and less in the marketplace, upon maturity, you get all this downside. But if the share price goes up above the maturity, above the strike price, all this upside here, of the share price performance doesn't go to the issuer, because as we know, the value above 100, the strike price, is only for the investor. So de facto, the profile for the issuer is that above 100 is flat. Totally the opposite for the investors. The investors is protected, so is protected until the share price gets into the strike price here, and he retains all the upside above 100. Okay? Those are glossary that I want you to learn, especially the first four that are relevant in order to understand, you know, how the convertible works. You have here the price of the shares, and you have the premium. So the premium gets applied to the share price at inception, and you got the conversion price. So it is the price where the shares are issued. Okay? How many shares? Let's assume that you issue a bond of 1 billion, will be issued 30.7 million shares, because you issued 1 billion divided by the strike price. Okay? The conversion ratio is the value of the bond, nominal, divided by the strike price. So basically, the conversion ratio is 1.538, which means you issue a bond that has nominal value at 50,000 euro, divided by the share price where the issue will be the shares will be issued, and you get the conversion. So for an equity investors, the parity is de facto the conversion ratio times the share price when you issue the shares, which is equal to a value, in this case is a 38, that is a portion of the bond, of the par. So because you calculate the conversion ratio on the share price which triggers the conversion, and this price is higher than the share price initial when you issue the bond, at the moment of the injection of the issuance of the convertible for the equity investors, the parity of the bond is 77% approximately, because the share price is at 25, and times the conversion ratio, it means that it doesn't reach the full 50,000 of the face value. So it's a bit more, it's a bit less, it's a portion of it, because of the conversion ratio at premium. Coming back for a second to those graphs, I remember that I told you that in equity, when you issue shares, is always a discount to peers in an IPO, discount to market in an accelerated book building offerings, discount to TERP when you have a right issue. Here, on the contrary, it looks that, you know, the share price is 80 and I will be issue shares at 100. Do you think that is an anomaly? So the convertible is an anomaly to the overall frame of rules in equity, and de facto you issue shares at premium? Is a question for you. Or even a convertible, de facto respect the rules that I told you. Come on, don't be shy. Don't leave me alone. I want to hear you. So there is a premium, clearly, no? Because you issue shares at 100 and the inception is 80. But again, is the reality? Okay, the value of the option, I understand. But, you know, we are talking about why the convertible looks that we issue shares. Of course, Lucas, of course, you're getting there. So Lucas said, in the money scenario, where you actually issue the shares and maturity, what happens? That you issue shares at 100, but the share price is, let's call it 120. So you have issued de facto shares at discount, because the shares will be issued at 100 while the market is north of 100. Of course, is a premium of, compared to the initial share price. But what really matters is when you issue the shares, when you do the IPO, when you do the right issue, when you do the accelerating offering in the marketplace. So when you deliver the shares always have a discount to the market. So also in the convertible, the rules gets applied in full. And indeed here, where theoretically 100 would be a premium to market, okay? But we don't issue the shares because the investors will not exercise the call option embedded in the instrument. So when you look at convertible, it is de facto debt plus the option, the call. And the more is fat, rich, juicy the option, the lower is the value of the debt. So the more optionality you provide into the call, so you enrich the equity content of the bond, the lower is the value of the straight debt. So in other words, if you have all the ways to enrich the option, longer maturity, low premium, and full dividend protection, and so on and so forth, de facto, the lower will be the coupon, and so on and so forth to the convertible. And let's see what happens. On the contrary, the perspective from an equity investors. We said that the parity is conversion ratio times the initial share price. So is the famous 77% in the example before. But then what you have the possibility to have those shares. So de facto, you swap all the economics of the bond from fixed income into equity. So you swap the dividend versus the coupon, and you got the call to convert. So de facto, for the equity investors, you know, the complement, the additional amount of value is all the equity component, which complement the parity that is below par. So for the issuer, you reduce the value of the bond, and for the equity investors is you integrate with the equity content the parity value of the bond itself. And those are the element that I told you before. So if you want to have a long maturity, that's reduce the value of the bond. If you increase the coupon, that's increase the value of the bond. If the risk or the interest rate in the marketplace are going down, that's reduce the level of the bond. And of course, if your credit strength as an issuer is very good, you increase the value of the bond. On the other hand, the higher is the premium, because you increase 20, 30, 40, 50%. So the more get remote the possibility to convert, the lower is the value of the option, the call. But on the other hand, if there is a lot of volatility, the level of the call goes higher, the value. And if the dividends are high, that is also limited, because at the end of the day, reduce the value of the optionality embedded in the call, because the level of dividend is already there. And call protection, as we can see later, it is a value that is an element that increase the equity options. Here we're going to go quickly, because again, I want you to see that you can have a redemption with a premium or a par or a discount. There are all features that are mathematically driven, so there is nothing to be worried about. Read it, and if you have questions, I can answer. But it is only a way to see the, how can I say, the level of flexibility that you have when you structure convertible. You can have an R call or a provisional call, which is the possibility for the investor to call before maturity back the instrument. So when there is an anomaly in the behavior of the market, so the share price goes up immediately, very high, in a very turbulent way, and basically create too much value for the investors. If you have the feature to call this bond back, either in a sort of a provisional or in an R call, so reduce the value for the investors, and basically the investors have the possibility to ask something in exchange, some protection, which usually is higher coupon or some protection in the structure. This is the settlement that I told you. So you can have either, let's assume that the bond and maturity worth 130, you can have 130 all cash, you can have the 130 in all shares, or you can have, the difference. You repay 100 in cash and you pay only the value of the call with the shares, okay? And you have the dividend mechanism. Basically, because the investor is a de facto an equity investor, he wants to be protected in terms of dividend. In other words, you can say, don't worry, I give you in full the dividend protection. And how does it work? It's very simple. The issuer provides protection that any dividend paid on the shares will be transferred to investors as well. How? Through a downward adjustment of the conversion price. So let's assume the conversion price is 130. Every time you pay €1 of dividend, the conversion price goes from 130 down to 129. And this is the simple full dividend protection. But you can have a protection also saying, I protect you from a dividend yield, or I protect you that I will transfer to you back the consensus in the marketplace. This is language, nothing to be worried about, but flip through the pages at the definition, because are important to understand the mechanics in the marketplace. This is a bond that in April 2020, in full lockdown, we issue for Nexi. Nexi has issued another convertible 2 weeks ago for $1 billion. This is the typical refinancing that I was mentioning to you in the first place. So let's see whether I respected all the rules and the key features that I mentioned to you. So we said, what is the ranking? Is a bond? Yes, is a senior bond. Does have any collateral? No, it is unsecured. And the bond is not rated because the rating is associated with the issuer. And in this case, it is a BB minus. Maturity, another important feature of the bond, is 7 years. But there is a provisional call that the issuer, in this case Nexi, the CFO Nexi, can call the bond back starting from 16 May 2025. In case the bond has a 130% value. So in order to avoid that you issue shares at 130, if he gets 130, the CFO has the possibility to call the bond back. Is an option. The coupon is 175. Conversion premium 50%, big premium. And here the Nexi management wanted to have a big premium because you know, they wanted to give the market a very important signal that they strongly believe in the upside of the stock, and we didn't want to have a trigger event that was too close to the current level of price, so they put a very high 50% premium. Of course, that translates in a coupon of 175, which is almost 200 basis point premium over the interest-free level. It could have been much lower in terms of coupon if you reduce the premium. Reference price, what was the 80 euro in our example, in this case was the 12.19. As a result, 19.47 is the conversion price. You got full dividend protection, and you got the title as well. And you know, Goldman Sachs was one of the book runner, a global coordinator. Here you have the same case with Pirelli. Please read it for your own education, okay? I wanted to show you EDF convertible as well, because I wanted to mention to you, even though it's not a specific feature and topic of this course, but it will be in the years to come, that the market, the capital market, is changing dramatically. All players in the marketplace, both as issuers or as investors, are becoming very much sensitive to environment, sustainability, and governance issues. In other words, you know, all the players in the marketplace, they want to contribute to have a better place, a better world. And the three most important issues are: you need to have a good governance. Governance means decision-making process that are based on equality, transparency, and addressing diversity. So the governance of a company needs to be in compliance with all the rules that are related to, you know, all these topics. Has to be sustainable, because doesn't have to create conditions that affect the sustainability, and has to be environment friendly. So for all these reasons, the investors pay a lot of attention of whether you have, as a company, as an issuer, the key performance indicator of those elements. Now investor will ask, whether you have board representation for women and for minorities. They will ask whether you have, you know, a policy for the CO2 emissions, whether you have, you know, initiatives to regenerate lands and to have a long-term sustainable farm activity. In other words, investors will ask these things, and if you respect these things, are happy to agree on better terms and conditions. In the case of EDF, it was a green convertible where the terms and conditions in the marketplace was priced, taking into account all these ESG elements. And let me tell you, at the moment, we are running around 40 to 50% of new issuances that are compatible with the ESG element. But in a couple of years, maybe even before that, we will be on a 2/3 level. In other words, 2 issuances out of 3, 66%, will be ESG compatible. And, you know, think about it. Assuming that in the marketplace there is an average maturity between 5 and 10 years, it means that in 10 years' time, more or less, maximum, all the market, all the equity bond market, not only the new flows, but also the stock will be ESG compatible. This is a very important element. And as you can see, also the university is dedicating a lot of time to teach and share concepts beyond these initiatives. So read it for your own education as well, even though the technicality are actually the same. When you have a mandatory though, when you have a mandatory, when we have classified a different class of a convertible, we said you can have a convertible normal senior where, you know, you issue shares in case the market performs. Here you forward sale, you have a forward sale of the shares where the structure of the economic profile for the issuer is as follows. This is the performance, the orange line for the market, you know, the share price performance. And basically the issuer has de facto a 100% downside protection here. Why? Because they issue a number of shares that are given. So de facto, they don't take the downside of the market here. They give away 100% of the upside to the investors here between 2 levels of prices, and then they retain some upside, in this case 17%, above a certain level. The opposite provision is to the investors, because the investors, no matter what is the market, will take the shares. So basically is exposed to the share price performance up to a level. Then he gets full upside, and then he has only 83% of the upside afterwards. While here, I mean, it's flat because at the end of the day, there is a collar here, as you can see. And here is market related, and then you have the a partial upside, 83%. This is the structure of a forward sale, where the issuer locked in minimum price and maximum price for the issue of the shares. And below that minimum and above that maximum, de facto either give away, it retains a full downside protection, or give away only a portion of the upside. And here you can see the features of these mandatory convertible, okay, in this bond. Again, you can look at it. The real element of the structure, because it's a forward sale, is that de facto, by forcing under any condition the conversion, because you forward sale, okay, the counter element of the bond is an higher coupon. So usually the coupon is very high. And let's look here what is, let me see what it is. Look at the coupon here, 5.5%. Every year you pay 5.5% versus the Nexi convertible, okay? It was 175. And why there is such a high coupon? Because you don't want to leave the option of conversion, but you want to have a forward sale. Now let's spend a bit of time of the third category, the contingent capital. I know, my friends, I can feel it. Your silence. That is a sign of, you know, less sparkling attention compared to the other session. I know that especially the regulatory capital section is very boring. I will try very hard to be quick and attractive, you know, in terms of messages as much as I can. Please stop me when something is not clear. When you go into regulated capital, you think about financial institutions. And even though you will be working corporates, you must know these things, at least in principle, because any CFO, any private equity player, any CEO of a company needs to understand, in principle, the mechanism of the capital market for banks, because when banks are functioning in a way, they are affecting the capital market on the other side, under any circumstances. And the regulators are key players in this industry because they supervise, and in some occasion they can be very dictating terms and conditions of the activity of banks, because actually they are the regulators. And as you can see, the regulation is totally complicated. It's totally complicated because you have a banking authority, and you have also authority for the market, and you have activity that is divided on ongoing activity versus when you go into resolution. And why is important here, and it is not important in the consumer business? Because while in the consumer business, nobody would care whether Coca-Cola would go bust or not. It's only a corporate event. People drink, you know, user of Coca-Cola will be very sad if it happens, but it does not affect too much the marketplace. But when a bank, rather than be ongoing, is going to a resolution, has implication globally, because you need to run off deposits, you need to restore confidence in the market, because you have people that are panicking. You know, the activity associated with banks requires a level of activity in case of insolvency that is multiple times more important than any other industry. And then you have the ECB, that is the supervisory board, regulating the activity, both in case of ongoing and in case of resolution, with different mechanisms. Here the ECB supervises 4,700 banks. SRB, that is the arm in the ECB taking care of the resolution, of course, as at the moment, you know, the supervision of 403 banks that are in resolution. And then these bodies regulate all the single regulator in the single jurisdiction, in the UK, in Italy, Bank of Italy, BaFin in Germany, and so on and so forth. That is only Europe, because then you have the same thing for the Federal Reserve, and for Bank of China, and for Bank of Japan. So think about 4 big regulatory entities in the world dictating rules, sometimes in a coordinated fashion, sometimes in competition. So it's it could be very complicated. I say sometime in competition because the Federal Reserve, for example, during the crisis of the 2007, 8, and 9, was much quicker to implement some measure compared to the ECB, not because they're smarter, because the banking market in US is united, while in Europe is a collection of jurisdiction independent from each other. So BaFin is a regulator in Germany, and now slowly, nice and slowly, step by step, ECB is taking care of the full supervision of 4,700 banks, but again, are only a portion of the total market. Here is only for your benefit. Let's talk about risk-weighted asset, why it is important. For example, Goldman Sachs has 1 trillion of asset. Okay, 1 trillion of assets, but those assets needs to be calibrated and weighted in terms of risks based on credit, market risk, and operational risks. And you have heard in the years, you know, Basel 1, Basel 2, Basel 3, and so on and so forth. Doesn't matter. But all these committee in Basel were dedicated to establish the following rules here. So how you calculated the risk-weighted assets. So let's assume that you have 1 trillion of assets. If you have, you know, cash, there is zero weighting. If you have interbank lending exposure, 20% weighting. For customer loans, it could be 50% when it's in bonus, or up to 150 in case of high risk, you know, kind of exposure. The same for security. And then you have all the other, you know, exposure like real estate, like plants, machinery, software, and so on and so forth. So de facto, if you have like a Goldman Sachs, 1 trillion of assets, you have 600 billion, in our case, in Goldman Sachs, of risk-weighted assets. Because you have line by line, element by element, you have weighted this 1 trillion times their own riskiness, and this 1 trillion reduce the amount of risk down to 600, which is the risk-weighted assets. Why are important the risk-weighted assets? Because you calculate the riskiness of a bank, and as a result, the amount of capital that needs to be attached to these risks based on the risk-weighted assets. And basically, when we calculate the core capital, which is a de facto tangible book, okay, all the real capital and reserve cash that the bank has, this gives you, you know, the level of capitalization. And basically, when we have a 13%, for example, you have $13 of capital associated to the level of risks. Think about it. This sounds pretty aggressive, but before the crisis, the level of you know, core capital for banks was between 4 to 5%. In other words, shocks in the assets would have been absorbed with only $4 of equity, which is very little. And the regulator said, no more. We have seen the crisis of banks. Please, you need to recapitalize yourself. And we have seen the private placement of Warren Buffett when the government, you know, when the government in US forced all the banks to get capital because they wanted to increase the core tier 1 ratio. So now banks in both in US and in Europe are much more capitalized, okay? And here is another perspective. As I told you, you get the total assets, and then when you adjust those assets for the market risk, credit risk, operational risk, you got the risk-weighted assets. Then you have the liabilities. As you can see, deposit is the biggest part of the liability. And you have here a portion of instruments that sits between, between liabilities and pure equity. Okay? And regulators have been working on how to create assets and liability structure that provides comfort to the market participant and the world in order to avoid the crisis that took place in 2008 and 9. So basically, you need to say that the funding has to be a combination of deposit, cover bond, repos, senior commercial paper. And then you have instruments that are there for bail-in and for the capital when is going concern, the core tier 1 and the hybrid instruments. In other words, they divided ideally the structure of the liabilities in a way that there are instruments that are there to support the bank in case of crisis. Those kind of instruments here. Okay? Forget all these elements. I put it here because if someone wants to be highly educated in those instruments, they can read it. But trust me, this page is never going to be asked for an exam. I want to reassure you. What I wanted to basically share with you in the last, let's call it 20 minutes, 10 to 15 minutes, is this element of a perpetual bond. Okay? And when you have these perpetual bonds that are the typical instruments, how they create equity. How this instrument that is a bond, you remember the features of Berkshire was a perpetual bond, so a bond that goes forever, and they used to have a bond, a coupon at 10%. Here is the same, is perpetual. Why wants to, the regulator wants to have this instrument? Because when it's perpetual, the liquidity that you raise theoretically can stay in the bank forever, because nobody can ask to have the money back, okay? But of course, in order to provide a bit of flexibility, this instrument can be callable, okay? But always subject to regulatory approval. So they will allow you to call him back, as it happened to Goldman Sachs with Berkshire, only if the regulator, Fed in that case, is happy with it. And they have two important features: write down or equity conversion. So to create equity, you have two options. Either you write down the liability when the event that triggers, the need of capital takes place. For example, you have had losses in the business, and your core capital goes below 7% or 8% or 5.25%, doesn't matter. There is a trigger event when you have losses and your capital get eroded and it goes down, okay? And it goes down to those levels. You have two ways to create capital. Either you say, okay, my core capital level went down to this threshold. As a result, I will, with the regulatory approval, I will tell you that a portion of your debt will not be due any longer. So rather than giving back $1 billion, I give you back only 700 in case of repayment. And as a result, the 300 are written off from the liability. And when you write off a liability, you create a capital gain, which means a boost in equity. If you write off your own mortgage or your liability, de facto you create equity. Or you say this billion will convert into shares at the prevailing market price at the time of the conversion. Now I want to have a bit of a debate with you in order to understand what could be the market reaction to those instruments. Market reaction. So the question is how the market reacts, whether you have these instruments or whether you have these instruments. So what happened in the marketplace? If a company that has issued a perpetual hybrid instrument that in case goes below 7% of core capital will convert into equity, what happened in the marketplace when the CEO says, I'm sorry to say, but I need to inform the market that, you know, because in this quarter we had losses in trading or a reduction in revenues in a jurisdiction, our profitability has dropped dramatically down to, and our core capital level is now below 7%. So we are discussing with the regulator, you know, the intention to activate the equity conversion automatically, de facto. So what happened in the marketplace with a statement like this, in your opinion? So the CEO says we are making losses, our capital is below 7%, so I need to convert. What happened in the marketplace? Anybody awake? Okay, very bad reaction. Can you articulate a bit more? Yeah, badly perceived. Please, can you articulate what happened to the share price? We have seen in the right issue, goes very much down. And why is so relevant that the price goes very much down? And it goes down, let's use the theory first, because you said to the market, I don't have a specific project. I don't have to repay debt. I don't pay dividend. You know, you remember the famous equation, sources and the use of funds? De facto, I'm asking you to convert your bond into equity. I'm asking you to have equity. Why? Because I'm getting losses. So market price, based on theory, should go down because I ask equity in exchange of losses. So the market needs to revise downward the valuation. And that is the reaction from an academic standpoint, immediate reaction based on finance principle. But then there is also technicality, because the market goes down, so de facto funds are starting to sell the shares. But also, bravissimo Lorenzo, but also here there is an important thing. While in the right issue, we used to have the mechanism to protect, at least economically, existing shareholders from dilution. Here is a fully dilutive instrument because the conversion will be segregated to the bondholder only. So the bondholder only with the perpetual instruments will be asked to convert the instrument. So the shares will be issued to them only. So de facto, the market cap of the company goes down because of economic reasons. But also, by going down, will be also shares in value to more shareholders, because we have this new category of shareholders that will be converted into equity. And guess what? More shares, the more the price goes down, more share you need to issue in order to convert a billion. And basically you start to create a spiral in the marketplace, and the share price falls down like a knife, okay? Share price falls down like a knife. Someone can say, too bad. Who cares? Existing shareholders can lose their own money. They knew that there is an equity instrument. You know, why we need to worry about? You know, the price can go down to zero, and what really matters is the sustainability and the ongoing concern of a bank. And as long as liquidity is not affected, who cares? The problem is with financial institution that really cares, because while in a corporate you can have a highly stressed level of debt, but you can run the company anyway because you are not in a regulated industry. In a regulated industry, you need to operate within some rules and thresholds, because otherwise you lose the viability. And when you start to lose viability, you go into the path of resolution, and the path of resolution means a lot of implication for the activity, and the bank disappears. But when this disappears, because it gets resoluted, you need to manage billions and billions and billions of deposits that are the money of the people, you know, on the street, your family, you know, the usual depositors. And let me tell you, when the market price for banks goes down to a level of historically, I would say between 10 to 15% of the book, when you have a price to tangible book 10 to 15%, means that the value of the bank is so low, they started to create a bit of panic in the marketplace. People don't believe in the viability any longer. And when this panic spread into normal people, retail people like my mother, myself, my wife, people start saying, is this bank safe? Is trading at 10 cents per dollar? And when they start saying, is this safe? They start to say, okay, you know what? I take my money out. And when they decided to do this in full capacity, we go towards the bank run. And bank run is the real catalyst for the bankruptcy procedure of a bank. Because banks, they will never go bust for lack of capital, but they will go bust for lack of liquidity. Because if anybody goes to the branch asking for his money back, the bank doesn't have enough liquidity to afford all these obligations. So, de facto, the unintended effect in the marketplace, in the share price, triggers uncertainty about the viability, which triggers emotions and lack of confidence in depositors, which triggers a potential, you know, a lack of liquidity in the bank. And actually, this instrument, rather than creating equity to rebuild up equity base and functionality in the bank, triggers the bankruptcy. So that's why the equity conversion, the automatic equity conversion, has been almost abandoned in the marketplace. And now all the market players, when they issue perpetual, they issue with the write-down features. Because rather than convert, you say, if I get these losses, I write off liability. And so it's not a dilutive instrument. As a result, after the share price reduction due to economic reasons, you don't have all the technicality that I explain later, with the share price falling down because there is more supply of shares and everybody selling, trigger the panic and trigger the illiquidity state. And here I show you. This is the Rabobank instrument. And, you know, it was 1.25 billion with this coupon. And basically, the write down was 25%. So in other words, if the core-tier-1 ratio goes below 7%, a quarter of this amount gets write off. That's very simple instrument, you know, in terms of feature, but this is the most recurrent, relevant, you know, instruments in the marketplace. So those instruments, they don't fix the problem, but they prevent the problem. So you cannot issue this instrument during the crisis because nobody will subscribe, underwrite an instrument that, you know, in case of losses, will butterfly into equity or get write off. But it's good to have it as an additional buffer of capital when in the future another crisis will appear. For example, look what happened in the marketplace. During the financial crisis, those instruments didn't have any market. Nobody would ever bought any instrument during the crisis because nobody wants to buy something that butterflies into equity when there are losses, because the losses are already there at the time of the issuance because there is the crisis. But all these instruments were issued between 2010 to 2020, and all these instruments were there to support the banks, capital base of the bank, okay, when the pandemic era, when the pandemic situation materializes. There was a big financial crisis in the market. Banks were very highly capitalized because they got all these instruments that supported, you know, the capital base. I have finished, but I'm happy to have questions before we close the session on equity capital market and equity-like instruments. So do you have any questions you want me to answer or issues you want me to address? I tried very much to be entertaining. Please don't punish me like that, you know. Show me any signs of vitality. The green shoe. Okay, we go back to lesson number 1. The green shoe is a mechanism that is masterminded for the potential downward pressure in the marketplace after the IPO price and when the shares are start trading. In other words, you have 100 of shares that are base offer and 15 shares that are related to the green shoe. So the total offer in the market is 115. I create a book by asking investors to give me bid for 115, okay? But those 115, as a global coordinator, 100 are sold by the issuer to the global coordinator, while these 15, the global coordinator has only borrowed the share, okay? So when I offer as a global coordinator 115 shares to the marketplace, is because 100 have been already bought by myself from the issuer and 15 are only borrowed. Then I sell 115 to investors, and let's see what happened the famous Monday when they start trading. If the share price goes up, everybody's happy. because it goes up. Why? Because there are additional investors that they want to buy the shares, and when someone will sell, there is enough demand through the oversubscription mechanism, because we create more demand than needed, and basically we price accordingly, and there will be investors that they want to have the shares. So no problem. But if the price goes down, so only if the price goes down, we have for a month a period of time where global coordinators and liquidity agents are asked by the underwriting agreement to act as a liquidity provider in the marketplace. And if the share price goes down, what happens in the market? It means that investors are more seller than buyers. The share price is going down. In order to address this additional level of sale, of offer in the marketplace of shares, you use the famous 15, the green shoes. You can buy up to 15 shares back into the market to support the share price. And after a month, what happens? If the share price went down, you repay back with the cash the 100 shares. But because you bought back in the market to support the market itself, you bought back 15 shares, you close the borrow with the issuer, not in cash, by giving back the shares. On the contrary, if the market went up, the shares have been sold, you don't need to buy back any shares. And after the month, what you do? You pay back the issuer the 100 because they're already sold for good. And you close the borrow with the issuer related to the 15 shares in cash because you didn't need to buy them back. That's the way the green shoe works. Is that clear now? I cannot be more clear than that. Thank you very much. Sorry, I lost the questions of the convertible.
Professor, you hear me?
Yes, very well. Oh, finally a voice.
It could be a silly, it could be a silly question, but just to have it super clear, if I am an investor, I am exercising a convertible bond. Am I getting newly issued shares by the company?
Newly
just
issued
kind of
shares. Newly issued
only
shares.
newly issues. Only newly issued, not secondary shares.
No, unless it's an exchangeable, and then you convert into shares of a third party.
Super clear, thanks.
Okay. So only primary is a capital increase on the back of it for a convertible. Of course, Lucas, the features of an equity-linked instrument or hybrid doesn't address the anxiety. So if a company, a bank, is making losses, market will be anxious anyway, but at least the write-down mechanism doesn't create the additional level of complexity associated with the new shares that will be in the marketplace, which create dilution, which creates artificial pressure on the share price, additional to the normal anxiety, triggering all the other events that I told you. So the write-down does not address the anxiety, but at least reduce the complexity from a technical standpoint. So thank you very much. We have finished the equity session. We're going to see, yes, you are responsible, Nicolo. Honestly, I don't get the questions. Who's responsible? I don't know. What I told you during all the lessons, I explain all the key slides that are relevant, but I strongly recommend you to flip through the pages and read it, because this is education. I cannot go through all the material, but if you read the case of Nexi, it's not because I'm asking you what we have done on Nexi IPO, but it's only for you to see that what we teach in the class is really much aligned to reality. In this respect, you are responsible for all the slides. I will never ask how does it work at the supervisory board for resolution of bank in Slovenia. That's not the problem. But if you know what is the resolution mechanism, is useful for you. Okay? In this respect, you are responsible. Thank you very much, and see you in 2-3 weeks time with the M&A section. Okay? Thank you very much for your time, and have a nice weekend.